Now you want me to talk about the fiscal expectations that seemed to be disappointed yesterday?
Yeah, huge disappointment yesterday, right? They had 5 very senior guys out there. They basically didn't deliver anything that the market had been expecting.
But where did that come from in the first place, that expectation? I think, yes, on the one hand, the PBOC, the government has surprised us in terms of their timing. Typically, they would not have launched such monetary policy stimulus before any of these meetings in December. But coming out with the fiscal stimulus yesterday, I thought there was too much expectation, because let's not forget, a budget proposal needs to be acknowledged and ticked off by the National People's Congress. And also yesterday, if you look back at October 2023, we had also the Ministry of Finance communicating around it. So none of that took place yesterday, and so we are still watching for mid or end of October, and let's watch out for any announcements on meetings on the NPC Standing Committee, and also announcements on the Ministry of Finance. These are the ones to go for.
How major a policy shift is this by the PBOC and, to a lesser extent, by the MOF in China? Because we had a guest yesterday who it'd be interesting to hear your opinion, Stefanie, as well. As a European, many are drawing the parallel with Draghi, whatever it takes. This is the PBOC's, this is China's whatever it takes moment. How convicted are you towards the China market and even property high yield? Or do you not want to go there yet?
I want to go everywhere you want to go, absolutely. And I've been sitting here so many times in this chair, having to defend a relative constructive medium and long-term view for China and Chinese equities and the assets, as we talk about. So we didn't have a very short-term catalyst. We have it now. And it is absolutely the whatever it takes moment for China. Now, the interesting part is also we're now getting forward guidance from the PBOC. And the second very important angle, not just the sheer size, which is also, I think, unprecedented in terms of stimulus in renminbi terms, but also very large in terms of percentage of GDP stimulus we get. But everybody also in the market was calling for that fiscal stimulus to happen. We have likewise, on the same day, the monetary policy stimulus came out, published accordingly. At that point, they didn't announce anything to that tune, but they're listening to the market. And the next day, rest assured, we got that assurance there will be fiscal stimulus. Now, of course, we are all sitting on our edge, edge of the seat and want to see how big is it, where does it come. But I have little reason to believe that there won't be any stimulus or there will be any disappointment. For all I know, they most probably will err on the side of overdoing it once more to make sure that that the market is getting what it's looking for to achieve what they are trying to achieve.
2008 and asset price bubbles potentially, which is the risk.
Because this is a market which has run up 30-odd% in just the last 3 weeks since that first, whether you want to call it a bazooka or a mini bazooka of stimulus, right? And, there are still a number of people who are working who remember what happened to China markets back in 2015. You don't think that's the case?
But before we draw any parallels, let's go back to examine why did we run up so much. There's always 3 things that is rallying a market. It's macroeconomic data. So the data wasn't good, but we got macroeconomic inputs in terms of the stimulus where we can start to draw back. But then most importantly, it's positioning and sentiment. And I thought the sentiment, the show of how bad the sentiment was, we actually got this on the 5th of August when we had the huge meltdown in Japanese equities. And we had an outsized downward move here in Asia in all the indices, informing Europe, informing the US equity markets. But the only 2 indices that didn't move down the same tune that day were actually the H shares and the A shares. And I thought at that day it was quite obvious sentiment was already so dire, positioning has been so low that there hasn't been any more negative feedback loop to this. So I thought that was established at that moment in time. So of course, we now had this repositioning. We saw the turnover was really high, but there is more to come, we think. So from a positioning perspective, you just look at the passive flows that could come on the back of the jump that the China percentage in these indices has made now to the tune of 4 or 5%. Just sheer rebalancing will bring more.
Yeah.
You look at the household deposit ratio to A shares is at an all-time high. So if any of that happens, we have already seen anecdotal evidence that there's lots of brokers now opening accounts onshore. So I think from that angle, positioning will be more informed with more to come, and that is also lifting up sentiment.